So last week we spoke to the problems with the 60-40 portfolio, particularly bonds. You've waited a week, now the solutions. So last week we talked about the problem with your portfolio. Most notably, inflation's up, interest rates are going up, bonds are going down, and for those in a traditional 60-40 mix, that's a big issue. Matt cut me off. He said, hey, this is too long-winded. This week he's on my case because I got a white shirt on a white board and apparently look like a floating head. I hope you can stay with me and keep up with what we think is a very important thing within people's portfolios. So again, just a quick recap. If you want more, we'll put a link in this week's commentary. What is the problem? Well, the problem in short is, inflation is up and likely to stay up for a while. Interest rates are up and climbing, and as a consequence, bonds are headed down. If you look at the classic 60-40 portfolio, right now it gives you about 1.5% income stream, best case scenario. Okay? Most people pull out distributions 4 to 5%, which means we got a gap right here, right off the jump, just from an matching up income stretch. Now, for a lot of people, they say, that's fine, but I'm going to take some out of total return. But the problem with that again, we covered last week is if you look at that 60-40 portfolio, 60% of your portfolio in the SPY has averaged 6% over the last 20 years. Your other 40%, if yield stayed constant, would maybe give you 1.5%, which comes out to about a 4% total return before inflation, before taxes, before fees, which again barely matches up. If you compound inflation out over a 10, 20, 30-year retirement, it's going to be a big, big problem for people, and one that, again, whether it's laziness or relying too much on past performance, isn't getting enough attention from either investors or advisors. So what's the solution? Well, the solution, number one, should be jumping out at you is pretty simple. Hey, marry up your income with your costs. Of course, most people want to live on more than 1.5% of their earnings, but there are ways, and this is where our high income series comes in, where you can generate 5%. Why is this so critical? Well, number one, if there's a shortfall here, and we're talking percentages all the time with you, I know, but these are really dollar values. If someone has $1 million, they want to take out 40 or 50 grand, not 4 to 5%. They don't want to take out 25 grand just because their account fell in half. It's hard to shrink one's lifestyle. In fact, it's usually one of the most important things people list as an objective to be met. So when the account goes down and you're still taking 40 or 50 grand out, you're taking out a much higher percentage, and this is where sequence of returns risk, Google that, comes into play. If we can match it up, if we can match up income and costs, we can avoid that. The other foolishness with this that we see time and time again, I'll put it in this analogy, is if you were someone or ran into someone who said, hey, my plan is this. I make 50 grand a year, but I'm going to spend 75, and my plan is to be able to pay that off with all the raises I think I'm going to get. You'd look at them, or be told if it was you, well, that's a foolish idea. Don't count on something until it's there. That's the same dilemma about paying things out of capital appreciation. It may or may not be there, period, moving forward. It may or may not be there in a given year. Most people don't want to go to bed at night with that type of concern. So let's marry it up. Let's get that income stream. Well, how do we do it? Diversify. You're like, Tim, I've heard that 1,000 times. Well, what does this mean? Well, one thing it means is look globally. Look outside just the U.S. You're not, again, when you go outside the U.S. investing necessarily in the country, but just great companies from around the world that may happen to be domiciled in another country. It is becoming a global economy. Don't limit your subset to a narrow group of things. It could be things even within the U.S., and we're writing about all these in this week's written commentary. Look at value stocks right now. We've been on this bandwagon. That train left the station a while ago. Goldman Sachs and JP Morgan will touch on this week why they think there's still a little bit more room left to run there. But don't limit yourself to 5 or 6 cryptos or 5 or 6 stocks. Diversification, again, means a big, big subset of options. And really point number 3, different than these, is looking at alternatives. Not just things like value versus growth US stocks, but things like infrastructure, things like credit parts of the fixed income, things like real estate. If you look at those last 2 examples, those were things that were left for dead. People were calling for defaults in the high double digits, 13, 15 type percent. Real estate was being left for dead with the whole everyone's gonna work from home economy, and yet high yield just hit an all-time high last week. Real estate is one of the top risk-adjusted performers this year, talking corporate, up over almost 20%. Again, within the credit, don't know that we'd be buying high yield with it at all-time highs, but there's so many different things you can get exposure to. Why are these things so important particularly? Well, number 1, again, is they're paying yields that are in most cases above 4% or 4% plus. So you can get that income stream you need. Number 2, they're great inflation hedges, particularly real estate. So it's something that's gonna hold up traditionally much better than your classic fixed income. And when it comes to credit, even in a rising interest rate environment, these are asset classes that usually do quite well. Because yeah, interest rates are going up, but usually that means the economy is doing well and the credit quality of these companies is getting better. Point here, summing it up all quick, is do the financially prudent thing. Don't let an advisor or broker talk you into doing something that clearly isn't how you got to be a client in the first place, i.e. spending more than you are bringing in. And number 2, look outside the box. Have a big subset of investments, whether that's from around the world, stocks that you might have abandoned over the last few years, or again, alternative asset classes altogether. This is how you take what appears like a very serious problem and bring some pretty straightforward solutions to get you, your family, or your loved ones to a much better place. With that, as always, if you want to dive deeper on this or get help for you or someone you know, feel free to reach out anytime. Thanks so much.